To the home buyers webinar. We have a focus on creative down payments today. We're going to talk a little bit about three main topics. We're going to talk about creative down payment options, ways to buy with little to no money down, options for where your down payment might be able to come from that may not be traditional that you've thought of before. Second, we're going to talk about, is this the best time to buy? Give a little bit of our opinions. Obviously, we don't have the crystal ball, but we'll talk a bit about what we see forecasting in the market, if now is a good time to buy or not. Thirdly, we'll talk a little bit about the fixed rates versus variable rates. We had the rate announcement yesterday, so we can touch on that a little bit and give it some opinions on the fixed versus variable rate in today's state. So for those who don't know me, my name's Eric Bekkers. I've been a real estate agent here in Ottawa for about 5 years now, helped over 70 families buy and sell in Ottawa. I currently live out in Greeley with my wife, 2 dogs. We've got our first kid on the way, so super excited about that. I'm lucky enough to be joined today by Andrew. Andrew's been mortgage broker in Ottawa for over 15 years. In that time, he's helped over 2,200 happy clients find the right mortgage solution. Andrew finds some joy and freedom in the smiles and excited clients getting the news that they've been approved, which is why he always puts people before sales. It's not for the sales. He's doing it to serve people in the best way that he knows. So thank you very much, Andrew, for joining us today.
Yeah, thanks, Eric. Thanks for the intro, and happy to be here. Absolutely.
Awesome. All right, well, let's get started. So let's start first. We're going to talk a little bit about creative down payment solutions. So Andrew, if you could talk to us a bit about some of the options that you see that are a little bit outside the box for how people are coming up with the money for down payments. I know it's a lot to save right now, and some of the options that you may have to get into the market.
Absolutely. So, I mean, traditionally, the two main options for down payment are a gift from an immediate family member, and usually that has to be like a sibling, a parent. However, there could be some extensions off that to grandparents, aunts and uncles, in-laws. And then without the gift from family, there would just be savings. So the lender would want to see that you've got the money saved from your own resources, and there are certain steps that they take to confirm that. For example, a statement showing that money's been there for at least 90 days, unless it's been coming in from income or the sale of a vehicle or something like that. So that would be your traditional route, the gift from immediate family and then savings. So what do we have outside of that? Well, and a lot of people might not even think about the gift. I want to say that as well. So if we just look at the traditional savings, when we get into the gift, if someone's qualifying now and they're shy 10, 20, 30,000, I know it can be a bit of a challenging question sometimes to ask family for that money, but if it does help get you into that certain price point, and they're on board with supporting that, then sometimes it's a question that it's a little hard to ask up front, but can go a long way. So gifted down, savings. We also have the RSP home buyers plan, and that kind of ties into the savings as well. So through the RSP home buyers plan, you're able to take money from your retirement savings and use that towards a house. But the sort of the catch to that is that you have to give it back to your savings. So you can't just take it out and then that's it. There is a requirement to pay that back within a certain amount of time. And then there's a minimum percentage per year that you do have to pay back into it. So you sort of have spent the time saving that money to use for the home, and then you have to kind of spend that time resaving that money to pay it back. Now, for those who don't have an RSP, sometimes they'll ask, should I open an RSP to do this home buyers plan? I don't really have any plan to continue with an RSP after that. And, you know, to, let's say, save $10,000 in your RSP home buyers plan to use for the purchase of a home, and then pay that back over, you know, the 15 years that you're required to, only to leave you with that $10,000 at retirement. From the retirement strategy point of view, maybe not the best avenue, and there might be some different things we can look to there for that. Another requirement that some people don't know is the money has to be in the RSP for at least 90 days. So if you're looking at a house wanting to make an offer in a month or two and wanting to put money into the RSP, you just have to keep an eye on your timing there. Another option is, and this is very new, it's the home savers account, a tax-free home savers account or home buyers account, where you can basically take up to $40,000 out of this tax-free account. And I believe there's caps on how much you can put in per year, sort of $40,000 with the total lifetime, with a maximum of, I believe, $8,000 per year. It's a very new policy or program, just getting launched now. And that's going to be another place for people to save money without the sort of tax implications of taking it out for buying a house, similar to the RSP, but without having sort of all the maybe some rigidity that can come with the RSP. So that's a great thing that's coming out, and something I would say, keep an eye on it as we learn more, as we see more banks and financial institutions and whatnot starting to open that up. So that's something to look to as well. And a product that's out there that not many people at all know about, sometimes even major banks, because it's not offered through major banks, is a flex down mortgage. And a flex down mortgage basically means that you can purchase a house without any down payment saved. So you still have to have a down payment, but it doesn't have to come from savings or family gift or whatnot. So this would be kind of getting outside the box. And these lenders will allow you to take the payment through a gift from a family or friend or an employer or something like that, where usually it has to be, sorry, not a gift, a loan, where usually it does have to be a gift with no payback, and it has to be an immediate family member, but it could be beyond immediate family, and it could be structured as a loan. So let's say your parents didn't want to give you $30,000, but they'd lend it to you. We could look to that. And then another option would be like a personal line of credit. So with that, if you were putting down, let's say 5% typically, but you wanted to put down 5%, but you just didn't have it, the 5% could come from maybe a little bit from parents, a little bit from a credit card, a little bit from a personal line of credit. And as long as you've got a bit of an exit strategy, because you don't want to get into a cycle where you're just making minimum payments on that interest only, and then that debt sort of never goes away, because it is at a bit of a higher interest rate, especially if you went the credit card route, unless it was like a low rate credit card or you had some benefits of minimum payments or minimum interest for a period of time. But long story short, the flex down is pretty awesome because you can actually come to the table with zero money saved for the down payment, be able to utilize something like a personal line of credit for that down payment, set up a strategy where you can pay back the line of credit in addition to the mortgage. And for people who, let's say, are paying rent and then also putting money aside to save for a down payment, it's sort of, well, instead of paying rent and saving for a down payment, almost pay your mortgage and then pay back your down payment. So you're still getting to the same thing. It's just you're going to own a house while you're doing that and be able to take advantage of the mortgage being paid down, the house value going up, and so on and so forth. So that's called a flex down mortgage. It's pretty much safe to say it's available through like mortgage brokers, because you can't get that through a major bank, and I believe through credit unions. I could be wrong there, but usually we get into our non-bank. These are still traditional lenders, still A lenders, but just non-bricks and mortar bank solutions. So there's quite a few avenues we can turn for down payment, and it doesn't have to be one or the other. It could be a little bit of RSP. It could be a little bit of savings, a little bit of gift, just to find that right fit. And as house prices go up, obviously minimum down payments go up. So the more options that you have for that down payment, that can help a lot.
That's fantastic. That flex down payment is something that's very new to me as well, and it's a great option for getting people into the market. Now, if you're going that route and looking at something with a flex down payment, how does the pre-approval or the full approval process work? Is it still qualifying at the same stress test that we're seeing that from the A banks on a traditional mortgage, or is there any different qualifications that they're looking at?
Great question. So as far as the stress test, debt to income ratios and whatnot, that would be all put through your standard guidelines. Credit score, they do want to see sort of like an A+ credit score, AA+, just without past collections or past bumps in the credit, because without having the down payment saved, it's a bit riskier, we'll say, for the lender. So where we kind of lack in the savings, they want to make it up in other areas like, let's say, employment stability, good credit score. So those will be some things that they'll be keeping an extra eye on. It is a sort of a great product, primarily focused for first-time home buyers. Someone who's maybe owned a few homes in the past, has gone through some credit challenges in the past, or maybe just likes to spend all their money, and they've got a brand new luxury car in the garage and all the bells and whistles. That product's probably not designed for them, because the lender's also going to look at, well, could you have saved the down payment, would be a question. And if you've gone and spent it all on luxury clothes and the visas are racked up and credit cards, and you got a luxury car sitting there, they might not, it might not be the right fit for that product. But one important thing to know about that one is that if you are borrowing money from a credit card, from a line of credit, from even family, they do want to take that payment into account in the application. So when we're looking at your debt to income ratio, how much income do you make versus how much debt payments do you have? If your parents say, well, I'll loan you that money for $300 per month, for example, and the little contracts designed, we would want to be taking that payment into account in the application. Or if you're using it from a personal line of credit, just like if you had a personal line of credit to buy a car or something like that, it'd be all the same. So we'd have to take that debt into account in the application as well.
Awesome. One other thing I want to note with those options is just talking a little bit about the gifts or loans from family members. And I think that's a big thing that we're seeing right now with, the baby boomers starting to get older. We're seeing a big transfer of wealth coming down into the younger generation as well. And that is a conversation that can be, it can be a little bit awkward to have with family members yourself. It's talking about money. A lot of families don't speak about it a lot. So I know I have in the past actually spoken to some families all together and kind of just explained a little bit and how they can use some equity from their home that they've built over the years in home ownership and passing it along. And a lot of wealth gets passed along, unfortunately, when people are passing away. And it's a conversation that, sometimes it can be better if they can actually watch that money be put to good use in helping some family get into a property and have something that they can still be around to watch grow as well and really help the family. So that's it's a very interesting topic and something that, we're open to having conversations with families about and seeing if it can be a fit there also.
Absolutely. And something important to add to that, Eric, is that even if the parents don't have a lot of savings, or if they have savings, let's say the market's down right now, they don't want to touch it, or maybe there's capital gains or other reasons just not to tap into that savings. Many people have perhaps like a secured line of credit attached to their home that they don't really use. And that's possible as well, that they could take the money from that and gift that to you. So it doesn't actually have to be from savings from the family member. The family member could actually take that from a personal loan, from a secured line of credit, for example, and use those resources to gift you the down payment.
Awesome. So lots of options there for coming up with a down payment, a little bit less traditional ways. Now, we'll move on to the next point. So we go into, is now the best time to buy, which is a super interesting question. And like I mentioned earlier, we don't have the quick crystal ball. We don't know for sure when the best time to buy is. But I think you and I, Andrew, are pretty certain on this point here. Is we've seen real estate happen over the years, and know that it's always a good time to get into the market. We've talked about this before, where real estate is a long-term play. Unless you're in the business of flipping homes, which is a totally different business, something we won't get into on this call. Real estate business, you are looking over the long term, typically a minimum of a 5-year period, which is, your standard fixed mortgage rate that you're seeing quite often. And over time, especially in our city here in Ottawa, we're a government city, very stable market. We're not seeing quite the ebbs and flows that other markets see. We get fairly consistent growth. We've only had a few years over the last 40 years. I believe it's been 4 years where we've actually seen any negative growth on home prices here in Ottawa. So in that term, we're really lucky. Now, one thing I wanted to mention as well is we see, you hear from the media in the reports that come out about home prices. You may have seen from last month, February, you see the media talking about us being down 14%, which is totally correct. If you look from last February to this February, home prices were down 14%. What you might miss there is that February was a peak. We certainly peaked in February, March of last year. Home prices went up about $40,000 on average for those 2-month periods, which was not sustainable, something that you rarely see. Now, one number that you don't hear talked about very much is we're looking at month-to-month equity gains. And from January into February of 2023, we actually saw a 5% growth in home prices in those 2 months. So I truly believe, I think we're very close, if not right at the bottom of the market right now. I expect to see a lot of growth. We've still got a ton of pent up buyer demand, and the inventory supply is still very low. You are seeing more homes sitting on the market, some more street signs sitting out there. So it might look like more inventory, but we're still only at a couple months of inventory on the market. So once we start seeing these interest rates holding, a lot more consumer confidence coming back, we still don't have quite the inventory that we need for the amount of buyers. So I do expect this spring, summer, and into fall to see a lot of buyers coming back out, and you'll see that demand going back up and driving the home prices up as well. So in my opinion, I think now is a fantastic time to buy. You hear it a lot, marry the house, date the rate. It's cliche, but it's totally true. That house is what you're going to be in for the next 5-10 years. That rate, whether you're taking a short-term rate, variable, fixed, we'll get into that a little bit. That rate can change. And over the next few years, you have opportunities to bring down what your payment is, but you can get into a house at the payments of today before payments are going up again. It's a great opportunity to get into the market. Is that kind of what you see there as well, Andrew? What do you think about timing?
Absolutely. For sure, you totally hit the bullseye. Just taking the words right out of my mouth. I can't agree more. When we say like things that the market is down, it's really a skewed result because we're comparing it with this insane busy market that we had through the pandemic, and we almost want to be down from then. It was too hot. It was moving too fast. Prices were going up too high. So this is a relief. So then a lot of that, the buyers who didn't get a chance maybe got outbid. Prices were just a bit too high. Now they do have the chance to get back into the market, and especially now we've had a Bank of Canada announcement where they didn't end up raising rates. That's some positive news going to spring market. More inventory is going to be coming out. I just had a client this week who was outbid on a property. They were competing against 8 multiple offers, which is interesting. I haven't heard that in a little bit of time now, but that might show that there's a lot of that pent up energy that people who couldn't really buy during the pandemic, but we're just waiting to see where things are going interest rate wise. Now the Bank of Canada said, hey, that's it for a while. Or hopefully, they'll be coming out and just actually, more houses on the market. So I think that energy is going to grow. And with that, prices grow. And if interest rates start to drop, then as they're projected to over the next year or two, then that's just going to keep speeding things up more and more. So now's an awesome time to buy. Take that, year over year drop in prices and put that in your pocket because it's going to come back. It's not like that's it and that seals off forever. When we look at home prices 5, 10, 15, 20, 50 years ago, it's up. So anything is down right now, it's going to come back up. It's like buying a stock when it's down. Now's the time if you had the money to buy stocks, if that's your risk tolerance and everything. Don't want to get into financial planning, but because there's a lot of great high value investments out there on sale practically. So it's like you can get a house on sale right now, which is awesome. And without all of the risk that's involved with multiple offers, maybe with having to go without conditions. People were buying houses sight unseen, like just making offers and not even seeing the house yet. So a lot of craziness there. It's good that it's calmed down a bit, but I do see a bit of trending towards that momentum picking back up. And so anyone who can cut that curve off and potentially get in now, I think that's a great opportunity.
Yeah, I would totally agree. And even just to add to that one more time, is I've seen, some properties that we've had for sale for a couple months now sitting on the market with not a lot of activity. And this week, as we came closer to this announcement and people were starting to think that maybe rates might hold, we've started to see showings and activity on properties that haven't had activity in a couple months. So really are seeing the market pick back up. Going to be interesting to see how it moves forward into spring. But at the end of the day, I do think it's a fantastic time to buy, get into the market, get that house that you want, like you said, at the discount, and the rate is something that will change over the term of your full amortization. So great time to get in at the good prices. That kind of brings us into the next topic of your rates changing and talking a little bit about fixed versus variable rates. So in today's economy and what we're seeing with the rates and the projections, was there any advice that you would kind of be giving to your clients right now in terms of which way to go?
Yeah, fixed versus variable, always a topic that we discuss, and kind of a bit of a hotter topic now because we've seen indicators that interest rates might start to drop. So with that, you normally want to have a bit more flexibility, either a shorter term fix like a 2 or 3 year or a variable interest rate. But then on the flip side, because there had been so many increases in the variable interest rate, it's quite high. Normally a 5-year fixed rate would lay below a 5-year variable rate would lay below a 5-year fixed rate at time of taking it. And then the whole point of that lower rate is that you're bringing on more risk. It could go up, it could go down, it could stay the same, but you're willing to take a little bit of upfront savings to bring on a bit more risk. But now that 5-year variable is give or take a whole % more than a 5-year fix. So you're paying this huge premium to have a variable interest rate. And with that, you're paying a premium to have no stability. So you'd really have to be confident that rates are going to drop sooner than later, because you're going to spend, day one until that time comes, paying a whole % more than if you had just taken a fixed rate. And these are just examples, not actual numbers, but you're going to be paying that premium. So not only do you have to make that premium up on the tail end when rates do drop, but the whole goal is to save money. So you want to make sure that on average, let's say over 5 years, you've done better than if you took that 5-year fixed rate. So the variable hasn't really been a popular option lately. We'll say not as much of a preference, unless people know something that we don't, but it just doesn't seem to be something that a lot of people are going for. I would say the most popular option right now would be a 3-year fixed rate. The 3 years is because in a declining rate environment, especially if people are saying, well, rates should be down maybe in about 2 years. And we don't have that crystal ball, but that's just kind of word on the street, we'll say. And one would say, well, why wouldn't we just take a 2-year fix? But the 2-year fixed interest rates are quite high right now. They're almost up there around where the variable interest rates are. So if the variable's kind of like too expensive, we'll say, and the 2-year fixed is too expensive, then a bit of a sweet spot is a 3-year fixed. And the 3-year fixed rate right now is around the same price interest rate wise as a 5-year fixed, maybe a bit more, but that premium that you're paying for flexibility is smaller with the 3-year fixed, and you still do have flexibility, not as much as the 2-year, not as much as the variable, but you're not taking that huge interest rate hit up front. So between a 5-year fixed, a 2-year fixed, a variable, all of that, we definitely, when we go through the goal discussions and where do you think rates are going to go, and would you be comfortable with this, and and would you be comfortable with that, we're going to get to the exact fit for you. Absolutely, that's all part of the process. And there's not one size fits all for mortgages, just like homes, there's not one size that fits all. So we're going to make sure we fit that mortgage to your exact needs. But it's nice to move outside of that 5-year fixed box. A lot of people just come with that programmed, 5-year fixed rate, but there's way more to it than that. But it doesn't have to be at a whole extreme 5-year fixed or 5-year variable. It's kind of like, I want a car. Do I get a pickup truck or a Porsche convertible? They're very different. There is some middle ground there with a 2-year, 3-year fix that we can introduce for sure.
Awesome. That's extremely helpful info. And it's important to note too, as he's saying, that, it's not one size fits all, and your plans of whether you plan to move out of this house into another house for yourself, whether you have plans of investment, pulling out equity, what you plan to do in the future with your next purchase is extremely important right off the bat when you're making your original plan for your first home, because that's something that needs to come into account for not only your mortgage, but also where you're looking to buy. If you're looking for something that's going to need a great area with some equity growth, or is it really just something that's an area that you really want to stay in long term? So creating these plans right up front is extremely important. So thanks for bringing that up.
Yeah, you're welcome. Absolutely.
All right, so that I think that concludes our topics for today. I think we touched on some great points, got some good information across. So thank you to everybody for logging in, being here live with us. It's helpful for us to have the live audience. Really great. So I will end the recording now, and we'll open it up for any questions you guys might have. We have about 10 minutes to respect everybody's time. Try and get out by 12:30, 12:35 at the latest there. So we'll end the recording, and if anybody has any questions, feel free to unmute your mic and ask away.